welcome to Fintech panel. No, nothing besides the Fintech in the title, but I think that there's lots of stuff to talk about. And I'll do with a very quick introduction of everybody on the panel. I will say a few words about myself. I'm Mrozowski, and I've been in Silicon Valley for about 30 plus years, maybe 35.
You're back?
So I stopped counting. And my fintech, I started to do the fintech in about year 20, around 2000 or so, when we introduced the first ever MasterCard payment platform. It was in the form of gift card. It was called Gift AmeriCard. And then I didn't anything in that space, but went into other things. And currently I'm working on 2 IoT projects. One of them is fintech. And that's about all I wanted to say about myself. I think we have such a great panel that I just don't want to waste anybody's time talking about myself. So I will start with the lady. So Julia, if you could tell us about yourself, and then we'll go to Ron, and then because Dan is remote, then he gets the third place to talk about himself. So
better place.
Thank you so much, Arthur. My name is Julia Valentine. I've been in fintech since 1997. JP Morgan, D. Shaw, Moose Partners, family office, top 10 in the world, and then COO, CTO of the Wisconsin Pension Fund with 110 billion under management. Started my own, became advisor to a number of fintechs, on the board of directors of a bank, and basically running technology and accounting and operations, kind of outsourced managed services and tech platform for family offices, VCs, and PE funds. So that's in a nutshell. And here's my neighbor.
Favorite. Thank you, Arthur. Thank you, Julia. Ron Davari. By nature, I'm essentially a nerd. Started in engineering, taught engineering, and taught finance, as well as do finance. Started a company that became BlackRock. Ended up working on some of the most exciting things that ultimately ended up trying to solve the issues of credit crisis. BlackRock, and then in 2008, crazy enough to say at the age of 50, time for me to do something entrepreneurial. And so my first company that was not entrepreneurial became NewOak Capital. NewOak went into essentially do everything BlackRock does in a private world. That was our, ambition, and I think that still remains. But the way we're doing it is through multiple ventures, and majority of ventures, thankfully, were funded by the credit crisis advisory work. So we put everything back because we didn't like to pay taxes, and I had a long horizon. So with that, we 2019, right before COVID, decided to what we call officially start what I refer to as a B2B2C platform integration, which is NewOak Finance. Underneath that, we have 2 very exciting subs that have really the world market as their sweet spot. One of them is cardless, pinless card, if you know what I mean, and it's not buy now, pay later. It's actually revolving credit, meaning that we want to develop long-term relationship. The good part about it is that it could go anywhere that internet goes, and hopefully someday also anywhere that Web3 goes. Right now, that's not really our goal. We decided we don't like any of the FinServ, FIS, so we essentially build our own. We decided we don't like Visa, MasterCard. We got rid of that rail. So everything we own from A to Z, all transactions are cleared for all the aspects of compliance and whatnot. As you know, if you're in anything you do with consumer, you got to pay attention to the compliance. To make the story short, we also found the world is made of either individuals or employees with employers. So we started a EWA from scratch. That's earned wage access with a potential target audience of probably 1.5 billion, if not more, globally if we do it right. So we're not worried about where maybe the fourth or fifth entry into the market, because that validated the concept was working, and also validated that new technology was going to be better than the old, because a lot of them started in midterm. So with that, I stop and tell you that we're not techie or finny. We're both finny and techie. Meaning that we're money. At the end of the day, we're money.
Let me know when you want to continue to put up the slideshow.
Daniel?
Yeah, so my name is Dan McAvoy. I'm the co-chair of the Fintech and blockchain practice at Polsinelli. And I guess I'd say at heart, I'm a capital lawyer as well as a regulatory compliance lawyer. So a couple of the areas in which I focus is the fund space. And when I talk about the fund space, that is both helping to raise capital within the fund space, working with a number of funds that have fintech and digital asset type strategies. In addition, work on some of their deployment work in terms of putting that capital to work, whether that be investing in token projects or more traditional venture type investments. In addition, on the other side of things, work with some of the biggest crowdfunding platforms, including and work on a number of projects for fractionalization of assets. So been working on everything from real estate to real estate debt to equity to single family homes and royalty streams and athlete income streams and various other types of interesting things that we've been either fractionalizing or tokenizing and trying to help to use financial technology to help democratize investing. So and then in addition, we on the blockchain side, we also work with a number of NFT platforms, layer ones, DeFi platforms, and other people who are trying to develop these new technologies and build things out. And we help with their structuring and with their regulatory compliance.
Well, thank you so much. And I just wanted to start with the fact that, and I think that Julia is going to explain that a little bit in a greater detail with the latest and greatest market research that whatever its the status of the fintech is, it's still there's a projection of growth and pretty substantial, right? So it's way above 20%, and no FTXs or any other things are going to overclips the fact that we have this new technologies like Web 3.0, DeFi, and I believe that Julia would like to start this with a little bit of like a very expensive research that she's been she will be sharing with us. So Julia, would you like to tell us what's coming up?
Yes, thank you, Arthur. So we have this very beautiful slide. Thank you, Marty, so much for putting this up there. The global fintech market is going to continue growing, and it's going to be this is just an estimate. Who knows, right? It might be much, much greater than that, but we're looking at a significant market, and it's not stopping. And if you think back about 30 years ago, we had nothing in fintech, like literally, right? I mean, everything was done on paper. And when I graduated and went into fintech, we were literally taking orders and trade tickets and automating, the entire flow. Like that was my first project. It was at Prudential Securities, and all fixed income trading was done on paper and by phone calls. And like in 1 year, it was completely STP. And people were like, whoa, we can do so much, it affects the level of client service, because now you can pull up a portfolio in front of somebody real time, swap out the bonds that they don't want, execute it and print out the report and just give it to them. And back in the day, that was the entire extent of portfolio management. This was in the 1990s, right? End of the 90s. So it's a huge market. And we want to talk to you a little bit about the cycles of the emerging tech. And this is the next slide, Marty. Arthur, do you want me to go like into the next slide? I'll explain it and then I'll open it up to the.
Yeah, that's fine. Yeah, that sounds great. Thank you.
Yeah. Yeah. So apologies. This is very, very tiny print. And it's because there's so much happening. And the way that Gartner explains all of this cycles is that they'll say, okay, there's an innovation trigger, and it's followed by the peak of inflated expectations. And it's because in order for money to go into tech, you have to really stand, on top of the mountain and scream about it and hype it up, because otherwise no one's going to notice you, because there's so many competing ideas. There's so many competing movements. So if you don't overhype it, I'm sorry, it's just gonna it's never gonna live, right? So that's the second part of the cycle. And after that, there's a trough of disillusionment, because everything has pluses and minuses. There's no good tech or bad tech. It's good for whom and what's the fit, right? And we basically pick our poison and we pick the pluses. And then at some point, people are like, whoa, this comes with so many drawbacks. And, if it's crypto, there's cyber attacks and it can be stolen. And people realize all of that, right, at some point. And then there's a slope of enlightenment that basically says, okay, it's like everything else. It's not great and it's not awful. It's kind of like somewhere in the middle. And you have to pick, the best founders and the best funds. It's just like, any other time in history. And then there's a plateau of productivity where basically you squeeze out inefficient and ineffective actors, from that space. People go bankrupt and the best of them survive. And we continue, just adopting that and rolling with it. And so this is like, God bless you. So this is like the story that's never going to change, right? So when people are like, it's crypto, is this, is that, it really, this cycle is never going to go away, right? DeFi.
The same curve could be for
It's the same curve
any
for
company within the space, or even in biotech, that same curve pertains.
I will even add to that, in any personal relationship, you're pretty much. Sorry, exactly. Where am I?
As long as you don't tell that to my wife.
In my circumstance, the curve goes up at the end, it doesn't flatten. It certainly goes up over a long fall.
Yeah. So at that, I'll leave it for a little bit, because we can, I want to turn it over to my friends on the panel.
Well, maybe I add a few things here. I'm very glad that, the innovations in embedded finance is not on this chart. So, I think when you're looking at there's a lot of what I consider here sushi knives, but no sushi. Meaning, ultimately you got to look at what the impact is on our lives. As we know, everything ultimately ends up in a transaction, and ultimately involves money. And our classic innovations have not changed a whole lot. The credit card that you're using, the debit card using, the payroll that you're using, maybe payroll has changed because, maybe 80% of people are getting it without using checks. But we were absolutely shocked that people are still having difficulty to do what is called off-cycle paycheck. If you, like in California, if you have to fire somebody, or you do, then you have to, within 48 hours, you need to pay them. And if you talk to the HR people, they pay $150 per employee, and that's how much it costs them to effectively implement it. And so I think we learned a lot by talking to the people who are in the trenches of trying to really make sure that their employees are, are not subject to liquidity crunch, and they're not subject to, what we call it 3 a.m. issues. So I keep looking at it. Maybe the most important application of this would be maybe NFTs at some point allows the transfer of money, but everything else is really, pure tech as opposed to what I consider real, ultimately, fintech. Fintech for me is not trading, it's not securities. That is only affect, the guys who are in banking, not the guys who live every day and buy stuff at the corner here, buy fresh strawberries from a truck, if you will. So I mean, I really think as this curve, as maybe in the microcosm looks like this, but in real life, the wave is far ahead of us. So you're looking at maybe a little noise. If you're familiar with, essentially, you may have been taking a small piece of it, magnified it, and it looks like, a roller coaster, but the actual trends are going to be, I think, 10 years from now, finance is going to be totally different than what you're looking at today, because you are able to do that. You're able to service people in Africa. You're going to be able to service people in Indonesia, 300 million, which so far the banking industry has failed to do so. So anyway, that's really my I think these researchers they're looking at where the hockey is today, hockey puck, not where the hockey puck is going to go. And I view that this is just a small.
Do you have any data on like banked versus unbanked people? I mean,
And I'll just give you one example. In India, less than 15% of transactions are being done with electronic. Some people say 10%. The banks are 100% focused on the top 10% and totally ignore the other 90, because the other 90 cannot even go to a bank branch. They can't get to it, and if they get to it, they're not welcome, in villages and whatnot. Go ahead.
And just on that same vein, could you just comment? So what do you perceive in those like low bank environments, say the digital crypto, environment rising up to even get ahead of the old traditional bank?
So I look at I think it's not the crypto. You may be looking at stable coins, and you're maybe looking at central bank digital coins. We're seeing that, Indonesia is doing that. You're looking at even India is changing its mind. Abu Dhabi has already done so through a friend of mine from BlackRock. It's coming. So I think that would allow you to not worry about the volatility you see in crypto, because that's just one manifestation of a blockchain starting. But ultimately, you want to go through the situation. I think that the wave ahead of us is going to be real world asset, and not real asset, just real estate. Real world asset are going to be more transparent, and they're going to be more information rich than your public companies.
And tokenized.
Tokenized.
fractionalization.
Yeah.
Not only fractionalization, I think people think of right now, the guy goes in, take a platform, says, okay, here's a token, go. There is no smart contract behind that. If I take this structured product world, which I lived for over 25 years, I was really shocked JP Morgans of the world were not looking and cheating, right? I said, the data is there, cheat, please. Cheat. And the point is, when you get into a structured finance, a state of proof of estate can be fully validated, and you have more currency. I would go to Adani and say, look, give me every single port you have and give me ability to put that on chain. The data, ships coming in, ships going out, bill of ladings. That data 10 years from now will be available. It's already available. People will know they can track their goods from, one port to another and see whether it exists or not. So that makes that asset a lot more available than for me. Right now, trade finance is a paper trade, meaning that you don't know where the collateral is.
Mhm.
But if you change that, that would be the best asset in the world to invest in, because you have collateral. You have frozen shrimp, you have sugar, you have coffee. You know the grade. You already had a control union putting a number on that box.
Right.
Do you rather do that or invest in JP Morgan?
And there's an Actus, it's a consortium that's putting together the contract information. Basically, what they're saying is there's a way to select 20 to 30 data elements that would describe any financial contract.
Correct.
We're talking about structured finance. I did that at JP too.
Yeah, of
So I
course.
understand exactly what you're saying. Like, there's a token, but what are the economics behind that token? So Actus is a consortium of thought leaders that are thinking through this. They went to FDIC. FDIC is loving them. So there's definitely work, going in that direction.
So, yeah, I have actually.
Yeah,
two
Julia,
questions.
I just wanted to
Oh,
pass
yeah.
something that
Good
really
Dan.
interests me. And
Compliance,
it
yeah.
kind of like directs the focus on the subject of certain not innovation, but the latest and greatest in the Security Exchange Commission and prioritization of all of their new technologies like Web 3.0, which kind of cuts into our discussion. But I would like to have Daniel to say a few words about that.
Well, yeah, and I mean, I think, and obviously the SEC is only one regulator of many regulators that are looking at fintech in one way. And when I'm talking about fintech, I'm not just talking about like technology that through which finance happens. So not necessarily just like payment processing, not necessarily just, but also technology that enables finance to happen, that enables people to able to do finance. So for example, I mean, a number of the technologies that were listed there on the last slide maybe aren't, strictly fintech technologies. They're not strictly things that are going to be used only for financial purposes, but they're developments that will allow people to more efficiently and more effectively service their clients and customers. They will allow people to better transmit information, to better understand, all of these things. And so I think what I'm saying kind of comes, with that backdrop to some extent. And the SEC has really, gotten in some ways into the financial technology business. It's just yesterday, there were two new proposals that on their face don't necessarily seem to be scream fintech at you. But but one of them is a proposal to go from T+2 to T+1 settlement. Well, you need a lot of technology in order to be able to get that to happen. It's already been not that long ago since we went from 3-day settlement to 2-day settlement. And so, this is one of the things that hopefully over time, with the use of things like blockchain technology, with the use of a lot of these other technologies, maybe even in the not too distant future, we'll be able to get to the mythical T+0 where people can actually settle in real time, which is something that people have been, definitely trying to do within the tokenization space and in other ways that aren't necessarily on stock exchanges. But we have that. In addition, the SEC yesterday also came out with a proposal to revise the custody rule. And so this is for investment advisors in particular. The investment advisors are supposed to keep all of their presently keep all securities and funds with qualified custodians. So this means institutions that are like, say, for example, trust companies or broker dealers or banks and other trusted intermediaries that need to go ahead and hold their assets. Well, one of the things that this revision to the custody rule would do is it would require all assets, and very much this has been targeted at digital assets in custody with qualified custodians, and that would be a very big sea change in the market in terms of what it is that people are doing, and frankly in terms of what people can do, because one of the biggest problems that we've had is that in a lot of contexts, it's actually completely impossible to custody a digital asset with somebody who would be a qualified custodian. Now, if you think about this going to all assets, though, I mean, extend this to some of the other things that people were thinking about, the frozen concentrated orange juice or automobiles or whatever other types of assets you might have in a fund. Well, how does somebody who's like an auto dealer become a qualified custodian? I think that's one of these question marks that's going to really, because it doesn't necessarily make a whole lot of sense in terms of the way that's been constructed. And then last week, the SEC talked about what its examination priorities are, and it includes a lot of things once again that are technology. One of them is mobile apps and how it is that mobile apps work, and ensuring that people who are actually using mobile apps for financial technology, that everything tracks through and that you have the proper controls in place and the proper cybersecurity. One thing that's huge, and it's not mentioned by name, but you can sort of read between the lines, is ChatGPT, and how it is that people are using AI and other types of automated communications methods to talk with their clients or to even provide investment advice potentially. And so that's something that's like really kind of on the verge and on the cutting edge that the SEC is in particular is going to be looking at very closely. Automated investment tools, similarly, anything that's using AI to go ahead and try and come up with investment recommendations, investment advice, anything along those lines is going to be looked at very closely, not only in terms of, well, is it, how is it functioning, but are you doing the right diligence? Are you looking, are you exercising due care to make sure that it's functioning properly, and that if you're giving automated advice, is it giving the right types of automated advice? So it's not just even the traditional robo-advisor, but I think we're starting to see a lot more AI being used in connection with like traditional wealth management services and things along those lines. And then also they're looking closely at the standard of care for crypto, and for what types of recommendations people are making in that regard. And that kind of touches upon a lot of what the folks at Pantera were talking about earlier, that you have certain types of investments that they want to, the SEC in particular for these purposes, going to look at a lot more closely than certain other investments, just because they want to, because frankly, it's something that's on the cutting edge. It's something that they're still trying to get to understand. It's something that a lot of the people who are in the industry are still trying to get to understand in some ways. And so, anytime that you have something that's new and different, it's just going to draw a higher level of supervision.
I don't want to go too far afield in the whole crypto discussion because there's a panel on that next. But what I would like to discuss is what are the immediate opportunities in fintech for the next couple of years, because a great example is that Wall Street lays people off. They need technology to replace them. Any thoughts on that? Because there's a lot of layoffs are going to be happening in the next year. I think layoffs are happening already, like Goldman Sachs or a place like that. Any thoughts about that, where there's opportunities, et cetera? Any really smart companies that people should be thinking about? I mean, I imagine that there's a lot of private companies that won't be going public because nobody's going public for the next year, right? So any thoughts?
I add a little bit, and actually, probably the ones who get laid off are the luckiest, because they're going to go, find a best use of their brain. I used to say, Wall Street hires people from University of Chicago and put them behind the desk and have them make PowerPoints. Why did this guy with study AI or a PhD in math doing what that stuff is? I see the life cycle in these people. They're totally wasted, and they feel that they can't do anything else after their first real layoff. And then it takes about 6 months later, they say, right, I could do this, I could do that. Their brains start working again.
Hopefully, yeah.
Right, that's the point, is that, I think ultimately I think the democratization of technology has the power of democratizing ideas and then implementing. So I'll give you a personal story. I left BlackRock and I gave my notice in 2008. And Larry Fink said, you're either the smartest guy or the dumbest. We're going to find out 15 years from now. It's not quite 15 years yet. So it's, you know, and my wife said, do you know what you're doing? I said, no, but I will learn. And that's really, and that was my first time I really decided that, you know, credit crisis was an opportunity rather than for me to go crap, right? It was really because the world is changing. I think everybody has to look at their life as a portfolio of options. And I gave that at a Brandeis graduation. I said, you know, use, you know, if you don't exercise your options, you know, essentially optimally, you're wasting a lot of your brain. And I think that's the way I look at it. You know, correction is a good thing. You know, setbacks are good. A vine, if it has a lot of water, it produces the worst. You're not going to buy that at a restaurant. So anyway, that's my thought. I think.
Julie, your thoughts?
Yeah, my thought is that JP always, you know, every 3 years, in terms of tech, they would cut 40% of the workforce. They do it to manage the earnings per share announcements. It's very much timed to financial, you know, to reflect costs on financial statements. Simultaneously with that, as Ron was saying, they set up an accelerator innovation program. You know, they're basically looking at, you know, who's coming up with which ideas, right? And then they would buy what people outside of JP, you know, actually create. So anything from accelerated to JP Morgan, for example, created this open DeFi platform where you can connect to JP's tech, and they're building like a, you know, an open source ecosystem, right, for the latest and greatest last generation fintech. So, and that all happens constantly. It's the constant cycle.
So Dan,
And-
any words?
And
Yeah.
yeah, and I mean, my thought, I got two thoughts. One is in the wake of FTX and everything that's been going on in that regard. I think we're going to see, or we're already seeing definitely like an uptick in the amount of compliance that people are looking to have. And so, you know, that the compliance tech area, I think, is something that we'll see, you know, big strides potentially made in. The other thing too is just to point out, you know, someone said, well, nobody's IPOing, but right now, there's more than ever, there's availability for people to invest in private companies. And that includes, you know, retail people who are able to go ahead and invest in private companies, whether that be in 506C offerings, whether that be Reg A+, but there's a lot of different platforms that are offering this availability, and including in the secondary market too. And we're seeing a lot of founder stock that's being, you know, still offloaded or sold. People are looking for liquidity, and that gives people the ability to go ahead and be able to buy into some of these companies earlier than they might have been able to otherwise. And so that's not necessarily a fintech company that is something to invest in, but something that fintech is enabling people to invest in.
I have another question. So I don't see crypto as being revolutionary, and the reason why is because tokenization requires market makers, so there's still have to be a human intervention. You can issue a token, nobody makes the market, it dies, right?
Mm-hmm.
So that's the fundamental
Right.
problem with it.
Yeah.
But you know, so there's a couple of old stories, right? There's a cell phone. McKinsey projected there was going to be like a couple million cell phones sold by 2000. It ended up being like 200 million, right? Because they said nobody had any interest, because everybody had to install phone lines first and then go to cell phones. And
Right.
instead, in emerging markets, everybody installed cell towers and skipped that whole generation. Another example is, you know, I've been all over emerging markets. I was in South America. You go to South America on payday, the lines to the bank are blocks long, right? But Uber drivers are like, guys who became Uber drivers are like, this is great. I get my deposit within 2 to 3 days of the money I make. It's all electronic. I don't have to go to the bank ever. It just gets deposited. I do everything electronic, right? So are there any of these kind of steps that you see happening in the finance world, in fintech, et cetera? I mean, I think that all these marketplaces are being created are all, many of them will be very successful, like Alan Snyder's marketplace, the marketplace that was demonstrated earlier today, the lending marketplace from yesterday. Thoughts?
Yeah, I can do a very quick one. So just like you were saying, cell towers, right, laying the highways, that ecosystem, the large investment banks are creating this open DeFi ecosystems, and they're basically saying, we'll lay down the cables, you just come and onboard on that. And so that ecosystem is being shaped up. And when it does, I think there's going to be like a massive transfer, over to DeFi architecture. We're not there yet because none of that foundation is there.
Do you
It
have an
needs to hit.
application that comes to mind, like right off the bat, that may work well?
Yeah, so if you look at one of the JP Morgan announcements, it was like about 3 months ago, they opened up that open DeFi platform. The name escapes me because you asked me, but I'll text it to you, and we should definitely talk about that. You can Google, it will come up, the JP.
Ron, anything comes to mind?
I really do think that look into a space a little bit. You will find that, that ultimately maybe the answer is cell towers to get to people, because there will be also every cell phone can act as a cell tower. Frankly, you can be effectively using each other's compute. I can be without really impacting you. There would be a network of, so essentially you need a population of phones to act like a cell tower. If you're looking at, I've seen also balloon technology when I was in Middle East, the group that is literally send out, high altitude balloons that act like a cell tower. You don't need to, and they in fact, empower many villages. They can, empower 100 million people in India far better than the telecommunication companies, and sooner than having to lay towers. So I think, in terms of that is concerned, I think I really do think that everybody will. Neither do I. Sorry, my phone is acting up.
Siri, you want to?
I wanted to.
No, yeah, you didn't understand it. I didn't program it properly, but the bottom line is that the opportunity is there. I'm sorry.
Nobody.
Right. Look, you got to look at there are bottlenecks in everything you do, right? But ultimately, I think these things become commoditized, and the applications don't.
Well,
The tech becomes commoditized.
The tech becomes commoditized. The ideas and applications don't. That's what I'm saying is that if you build a very solid EWA, earned wage access, or if you build a ability to bypass the standard rails and credit cards, and if you're able to put money in somebody's pocket at 3 a.m. without having a whole lot of systems, that will not be commoditized because you need the infrastructure to do so. You need to have cash in the bank to do so. That's why I'm saying, if you're a tech, you're going to be at some point, somebody better, faster comes along and you push you out. But if you're finance and you're really putting your money where your mouth is, then you, in fact, going to be able to capture the market. Or if you're an MRAG, ADP, for example, today has not become a lender, has not provided companies with liquidity. All they're doing is just running payroll, right? But they're wasting all that data. They could be a finance company.
Yeah, I just I think we
have time for one more question.
let's
Yeah, I have a question to the panel because there's two technologies that are growing right now, and it's just like really briefly because you have this computing that is happening at the same time as the Web 3.0, and all of a sudden all of the cryptocurrencies and the safe contracts using the blockchains are sort of endangered. So is that something then that anybody is thinking about it? Because it's going to be 3 to 5 years when the quantum computing is going to crack the Bitcoin.
Well, I think that there's certainly a question about that, and I think people are, using this in a way. I mean, look, the development of high power computing is going to be essential for the further development of smart contracts and to be able to make them, quote unquote, smarter, to be able to automate more of what's going on, to be able to actually store sufficient data. I mean, which has been really one of the biggest issues with, biggest impediments so far with blockchain is that, there really isn't the computing power necessarily to store all of the information that you want to be able to keep on chain. So I think these are things that are going to go hand in hand, and for whatever it's worth on Bitcoin, whether it's cracked or anything else, people. I think what we've seen is some resiliency there, and also I'm fairly certain that as time goes on, these things become more apparent, that people tend to go ahead and find solutions, and I think while that hasn't been any major change with Bitcoin, I think we saw it with Ethereum and the merge, and the fact that people were able to go ahead and agree to develop this in a way that makes it more environmentally sound and helps solve for problems. And people who are Bitcoin people are going to look for their own self-interest as well, I think. And as these problems start to arise, they'll find ways to solve for them, I think.
Hey, Dan, are smart contracts impacted by quantum computing?
Sorry?
Are smart contracts impacted by quantum computing?
Well, I think the amount of computing power that you have impacts the ability, what you can do with a smart contract, right? And so I think that's there is some correlation. Whether or not people will start to generate smart contracts through AI, I mean, that's not out of the question. Right now we're still just learning how to chat with AI. So
Just add more notes, that's all.
I think Julia has a comment, and we're closing now.
Yeah, as a closing remark, this is the path of evolution. Look on the left. This is where banks used to check on more and more and more functions and aggregate all of them. And now pretty much if you don't want to offer crypto as a bank, what's happening is that in that rebundling scenario on the right, someone's just going to assemble all these functions, plug in crypto into that, put it on your mobile phone, and circumvent the bank, circumvent the ADP, which is what you were talking about.
Right.
So technology has reached maturity to a point where you cannot stop that progress, because it's with or without you philosophy. It's like, hey, you don't want to offer this to me as a client, as JP Morgan or any other bank, not to pick on them, right? Robinhood is someone else is gonna come in and rebundle all of these services, put it on your mobile phone, and then banking is just a commodity. So this is how evolution in fintech happens, and it's unstoppable at this point.
Wow.